Very good evening to all of you. Welcome to Demand Supply Trading Practical Session number 30 for the year 2024. Myself, Sujit Kakar. Today is Sunday, 4th of August 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So we have a channel on WhatsApp, which is where we keep updating you, regarding the schedules of our upcoming session, or if we have any promotions coming up, or if we have any videos coming up. So, in case you wish to join that channel, you can scan this QR code. Otherwise, you will also be able to find the link in the description. You can click on that link and straight away join that channel if you wish to. All right, now talking about today's session, it's the practical application of demand supply methodology. Our demand supply methodology course used to be a paid course. Now it is available as an absolutely free course where you can learn the complete methodology, understand what demand supply is, how to identify zones, how to qualify zones. And the link to the course content is available in the description. So you have access to the playlist. It is available in two languages, English as well as in Hindi. So whatever language you're comfortable with, you can learn the complete methodology in that particular language. Now, the course basically covers demand supply methodology theoretically, right? But unless and until we have hands on experience, right, we have practical examples, we don't get very good understanding of how it has to be implemented. And that is what we do in these sessions. In the weekly live sessions, I share some examples with you, and to those examples we apply the complete methodology. Now, the beauty of demand supply methodology is that the areas where we would like to be buyers and sellers, they can be pre-planned, and that is what I do in these sessions. So while we are planning these trade examples, I'm not sharing something which has already happened and we are going back and just reviewing it. That is not what we do. So to show you the real beauty of the methodology, we are always pre-planning, okay, these are the areas where we would be, willing buyers, or where we would be willing sellers. And whenever prices, they revisit those areas in the future, that is the time those trades, they get triggered. So that is the beauty, that we are planning in advance. And just because we are planning it in advance does not mean, I just share these examples with you and then we forget about it. Whatever examples I'm sharing with you, whenever they get triggered in the future, we also review it. So that gives you the holistic understanding of the methodology. When we planned the trade, after the prices came into the zone, how did the trade play out? And that also keeps everything transparent, right? Because if you're just picking something which has already happened, that is something anyone can do, right? But when you're planning in advance, and eventually the prices, they come into the areas and the trades, they play out, then you start having more confidence in the methodology. And that is what I'm trying to do here. I'm trying to help you people understand that yes, if you are following rules, if you are trading based on your rules versus emotions, you can be a net profitable trader. Yes, it is obvious that there is no such strategy in the world where every trade is going to be a profitable trade. So you will have winners, you will have losers, but what you will realize is that with demand supply, the reward to risk ratios are really, really nice, and that is what keeps you on the positive side. All right, so before we start with today's example, we do have one example which was getting carried forward. Right now, this was the trade example which I took in session number 27 for the year 2024, and the session was on the 14th of July. So if you go back and you'll be watching the recordings, when we planned the trade, it would be something like this, right? So that is what I was telling you, we are always pre-planning. So at the time of analysis, it was something like this. And the last 2 weeks, I guess, we did talk about it, that the prices have already been into the zone. Yes, we did have a gap down deeper into the zone, which could have made your reward to risk ratio even better. But going with exactly where our entry price and the stop loss was, we talked about that our nearest opposing zone is somewhere around here, which is giving us a reward to risk ratio that is approximately 2.6, 2.7. And you can see eventually, yes, prices, they did start moving up. And this week we have achieved our target one. We also talked about that this supply can be a target two, but not a bad reward to risk ratio, almost close to 3:1, which made it as a qualified trade for us. And anyhow, it was a type 1 trade for us. And talking about, if your entry was a little deeper, then your reward to risk ratio is even more lucrative, right? So if you look into it, if you were having a little deeper entry, then you could have got about, let's see how much, if I just hide this for a second. In fact, let me not hide it. Let's see, this is no, I'll just move it, right? So then you can see we have 1 is to 1, 2 is to 1, 3 is to 1, 4 is to 1, approximately 5 is to 1, right? So because of that deeper entry, you could have got your 5 is to 1. But yes, if you are going with the original entry and the stop loss, then you have had about 2.6 or maybe 2.7. All right, so that takes care of the only trade example which was getting carried forward for us. And now that we are done with it, we can start with the analysis for today's example. So just give me a few seconds. Let me bring that up. Now, today's example is again something which is a little different from what I have been sharing with you for the last X number of sessions. And that is what I keep talking about, almost every other session, that what happens is I try to pick different kind of examples for you, because when it comes to learning something theoretically, everything is a textbook example. But when you get into the real world, there are a lot of variations, and how to handle those variations, we have to learn it. And again, also based on your personality style, some people might be conservative, some people might be aggressive. So today's example is again a beautiful example where you will see that me being a little conservative trader, why I made some shifts in this trade setup, and also a few reasons which will also make maybe more logical sense to you why I did that. So a good example again to have some practical understanding of, if you have multiple areas, depending upon your personality style, a person might be interested in different areas versus, whichever might be the nearest one. All right, so starting with the today's analysis. So when we talk about trading, I always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. The link is available in the description. And again, during the session, if I talk about some videos, if I talk about some documents, all the links are available in the description. So not to worry, where do I find them? Just look into the description, you'll have access to it. Now, the video I was talking about how to start trading will help you understand why you need to be mechanical and rule based. And it will also help you understand what is the process you should be starting with, right? And everyone will have to go through that process, maybe twice, maybe thrice, but there is no bypassing it. So make sure you follow that process. The sooner you start following it, the better it is going to be for you. But eventually, everyone has to come to a point where we need to create a trade plan for us. Now, what happens is when you start learning trading as a fresher, or maybe when you're even starting learning a new methodology, the very first day, it's not easy to create a trade plan, right? Because you need a lot of experience to convert your trade plan into a rule-based mechanical system. So to overcome this challenge, I have created a trade plan for you, which is basically a combination of two documents. The first one is your trade plan steps. You can call it as the flow chart. You can call it as the walkthrough, which guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. And mind it, this rule book is a conservative approach, because definitely when you're learning something new, it makes sense to be a little conservative. With time, with experience, you want to make some modifications to it. That can be done to make it better suit with your personality style. So what is our step number one when we start planning our trade? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration is the time you enter the trade to the time you exit the trade. Now, why are we starting with the trade duration as our step number one? The reason is when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So how do I decide out of these a number of time frames, which time frame should I be using for my analysis? And the answer to that question is that we define our time frame based on how long I want to participate in that trade. And the logic here is the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is why this is our step number one. We choose our trade purpose so that then we can pick time frames which are in sync with that particular style of trading. Now, what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or a few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But the challenge is if you're trading markets that are not 24-hour markets, then I'm pretty sure all of you would have experienced whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting. But the downside is if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we are holding a position overnight, because of that gap up or gap down, I can lose more than what I'm willing to lose on that particular trade as per my risk management rules. And to overcome this challenge, of gap up, gap down, initially we don't want to do daily income trades as overnight trades because when you're learning something new, initially you're prone to making mistakes, and we would like to be on the safer side by practicing risk management, not keeping the daily income trades as overnight trades. So initially your hourly dailies will be strictly intraday trades. For weekly monthlies, anyhow, you're not expecting to get the exit the same day, so here we have no choice. We'll have to keep these positions as overnight positions, but that does not mean for weekly monthlies we cannot have gap against us. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, if you want to include daily incomes into overnight rates, that can be done. Nothing wrong with that. It's just that initially we are avoiding it as a risk management rule. So let's assume I opted, I want to plan monthly income trades. Now, once I have opted my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with the topic which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of four different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my time frames? And you get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, now I know my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, it is going to be the 60 minutes chart, and it can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this can help us. Now mind it, this table which is on page number 31 is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes during the day. It's open for a very short duration. If you are trading markets which are open for longer duration, like your commodities, forex, cryptos, then you can refer to this table which is on page number 32. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but on NSE we have approximately 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need now is a process in place which can help me select a smaller list, because if I have a small list, I can do my analysis almost every other day. But going through 2000 plus companies every day is not an easy task, and I'm pretty sure nobody would even want to do that. So the way we get a smaller list is by using certain computer programs which are called as scanners or screeners, and that is what we are doing in step number 2. We are selecting few symbols. Now, what these scanner screeners, they basically do is that we input certain conditions into them. These are the conditions I'm looking for. And then the scanner screener identifies that out of these 2000 plus companies, which are, or 2000 plus symbols, right? It's not just companies, it could be anything, commodities, forex, cryptos, right? Whatever. So it will identify that out of those n number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very important thing which you always have to remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols, because the scanner screener is never telling you what you need to buy or sell. It is just helping you get a smaller list out of a bigger list. Now, once you have that small list, you will have to analyze each and every symbol manually and compare it with your trade plan. Whatever is in sync with your trade plan might be your opportunity. Whatever doesn't match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you which are based on some moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll again be able to find a video on top-down analysis, which can help you again in shortlisting some symbols. So these are 3-4 different examples, but we are not restricted only to these 3-4 different scanner screeners. So let's look at few examples before we move ahead. So like I was talking about, once you come to our website and the free tab, you have a stock screener. Because I opted, I want to plan MIT trades, I can click on it. I can run the long scan and the short scan. Now here you can see the long scan is shortlisting about 5 symbols for me. But like I already said, whatever results you get does not mean you can blindly buy them or sell them. So as an example, if the long scan is giving me these 5 stocks, does not mean I blindly buy these 5. Similarly, if the short scan is giving me 1 symbol, does not mean I blindly sell this one, right? So always remember, the scanner is never telling you what you need to buy or sell. The job of the scanner was, I can't analyze 2000 plus companies every day. It gave me a list of 6 symbols. Now I have to analyze these 6 one by one. Out of these 6, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have any opportunity. Now, many times what might happen is your list might be a very small list like you can see today, or maybe no results are getting generated because nothing is matching with these conditions. Or even otherwise, if you want that my list should always be a little bigger list, because if I have a bigger list and I go through that list, the probability of getting something which is in sync with your trade plan definitely increases. So in such case, if you want your list to be a little bigger, you can see that I've given 5 different conditions here. Just disable the third one, run the scan again, and I'll do exactly the same thing here. Disable the third one and run the scan again. And now you can see that initially it was only giving me about 5 symbols, but now after disabling this condition, it is giving me a list of about 115, and the other one is giving me a list of about 8. So we have 115 plus 8, which is 123 symbols to look into. So now you can see your list is a little bigger list, which I'll say it's not a very big list. It's not that you have to analyze 500 or 600 symbols. 123 can be easily done, I'll say, in about maybe half an hour, 45 minutes. But yes, if you still feel the list is big, you can again apply different filters. Example, I can say I don't want from the cash segment, I only want the symbols which also get traded in futures. I can run the scan again, and now you can see from 123, I'm down to only 33 symbols. So this is how you can have different filters, different list size. Plus, if you go to the screener section on this website, you can see you have over 150,000 scanners available to you on this website. Some are based on fundamental analysis, some are based on your top love. Then you have your candlestick patterns, then you have your range breakout, you have bullish scan, you have bearish scan, you have intraday bearish, intraday bullish crossovers. So a number of scanner screeners are available, and this is just one website. You do a Google search, you'll be able to find a number of websites, a number of scanner screeners which can help you get your list. Now in this example, you saw that we got a list of about 123 symbols. Now when you start analyzing them, again few more challenges which you will realize. Challenge number 1 is you will realize that on majority of these symbols, you don't have a quality demand zone or a supply zone on the lower time frame, which means when you're doing your analysis, you're wasting a lot of time analyzing such symbols where no quality areas are available, right? Which definitely is a waste of time. And second challenge is some of these symbols which might have some quality areas, those areas might be far away from the current market price, which is where you'll have a longer waiting period before the prices are back. And during that waiting period, whatever price action develops, it might even disqualify the setup by the time it is back into your zone. So these are some of the challenges we face when we are using scanner screeners, which are based on conventional technical analysis or fundamental analysis. And to help you with these challenges, we have also created 2 tools. One is called as the alert service. The other one is the screener. Very important. These are not call giving or tip giving services. These are also scanner screeners. The only difference is both of them are purely based on demand supply zones. To have a better understanding, you will be able to find the walkthrough videos link in the description. You can go through those walkthrough videos and understand them better. But quickly, just to help you understand them, what they do. So what alert basically does is that as soon as you have a formation of a demand area or a supply area on the chart, it immediately notifies you. And we do have some demo channels. We have the demo channel for NSE, MCX and Forex. So here you can see for the 2nd of August, we give NSE alerts from 11:15 to 11:45 Indian Standard Time. So here you can see as and when the zones were getting formed, we were getting these alerts. You get to know the name of the symbol, what was the pattern, on which time frame it was formed, what was the proximal line, what was the distal line. You can see this is for 5 minutes, 5 minutes. Then you have your 15 minutes. Here you had for the daily time frame. So as and when these zones are getting formed, you keep getting these notifications. But again, remember, just because you're getting these notifications does not mean you can blindly buy or sell them, right? So what the screener is doing is it is helping you. I mean, the alert is doing is it is telling you that on this symbol, on this time frame, a zone has formed. So you can match that zone with your trade plan. If it qualifies based on your trade plan, it can be an opportunity for you. If it doesn't qualify based on your trade plan, it's not an opportunity for you. So that is what alerts is all about, and it is based on the live market. So real time, as and when the zones are getting formed, you keep getting these updates. So that's your alerts. Similarly, we have another tool which is called a screener. Now, screener has nothing to do with the formation of the zone. It has to do with when the current candle gets closer to a zone. So here you can see I've applied the screener, and in the screener I have given a list of 40 symbols. Now if you have a paid TradingView account, you can apply the screener multiple times on multiple charts, and you can have as big of a list you wish to. And now you can see that once I have applied this to the chart, and I've given my list of symbols. Now it is, and the setting I've given here is that out of these 40 symbols, wherever the proximity is 1%, which means the current candle is within 1% to a demand area or a supply area, shortlist for me. And here you can see it is shortlisting 2 symbols only for the demand side and 2 for the supply side. So you can see I don't have to go through 40 symbols now. I know these are the only 2 symbols for long side, and these are the only 2 symbols for the short side, which are closer to a demand area or a supply area. So instead of wasting my time analyzing the other 36, I can just look at these 4, because the other 36 are nowhere close to a demand area or a supply area based on my preference, right? Those numbers can be changed based on your preference. So example, if I go to the first one, which is BAJAJ, Bajaj Finserv, you will see it will be closer to a demand zone. You can see we have a demand zone, current candle is close to it. That is what the screener basically does. And currently I'm on the daily time frame, so it is telling me based on the daily time frame. If I change my time frame to weekly, now the results will be based on the weekly. So you can see you can even change your time frames just at a click, right? Your time frame changes. Now here you can see in Asian Paints, let's say if I go to Nestle, I'll be closer to a supply zone on the weekly, and here you can see we have this rally based drop and we are closer to this supply zone. So this is what the screener does. It helps you identify symbols where the current candle is closer to the zone. Whether that zone was formed today or a week ago or a month ago or a year ago or 10 years ago, doesn't make any difference. As long as you're within that proximity range, it will shortlist it for you, right? So that's what screener is all about. And now I've shown you a number of ways of shortlisting symbols, some based on conventional technical analysis, fundamental analysis, two based on purely demand and supply zones. So the end result we want to get from our step number 2 is a smaller list. How you get that smaller list, it is completely your choice. So I won't say that these tools are mandatory tools. It's your call how you want to do it. A very simple example can be, maybe I just want to analyze my Nifty 50 stocks, so now my list is restricted only to these 50 symbols. Or maybe I have my own favorite list of stocks which I want, or my favorite list of symbols which I want to analyze every day. So it's your call how you want to get that smaller list. But definitely the more it will be in sync with demand and supply, the probability of finding tradable opportunities definitely increases. All right, so that's your step number 2. So step number 1, we got to know our time frames, which were monthly, weekly, daily, and 60. Step number 2, we got to we got our list, whatever method you used. And now what we need to do next is we need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, lower time frame is daily. So we'll go to daily and we need to identify a zone. So we'll start with the very first symbol. Let's assume it was ABC. And now I need to identify any of these 4 structures on it. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So if you go back, as of now, you can see I have the demand supply zone indicator applied, and you can see that the demand supply zone indicator automatically identifies the zones for us and plots the zone for us. Now, when we start learning demand supply methodology, we start with a concept which is called as boring exciting, which is based on the size of the body versus the range of the candle. And again, when we talk about demand supply, I also say that it is a price action based methodology. Now, by price action, we mean the action done by the price. And what action can price do? Only 2 things. It can either move up or move down. But when moving in a very narrow range, that is what we call as our period of pause, or we can also call it as our base. Now, like I was saying, that initially when your eyes are not trained how to identify these structures, we do start with the concept which is boring, exciting, but that's just a starting point, because you will see most of the zones can be identified based on boring, exciting technique. Very important, I'm saying most of the zones. I'm not saying all of the zones. Now, once you start having more and more experience and your eyes are now trained to identify these structures, then what you do is from boring, exciting, you start shifting towards where do the price action, is showing me these kind of patterns. So when you're looking at price action, all you're trying to do is, if I just remove all the indicators, you're just visually trying to see how the prices were flowing. So here you can see we moved up, we paused for a while, we started moving up, and that is what we call as a rally based rally structure. And that is what the indicator is identifying for us. So let's start with the zone above, which is this one. And eventually I'll shift to the lower one, and that is what I was talking about. You will see why I made that shift. So that's your very first zone, and that was our step number 3, identify a zone. Do we have a zone available? Answer is yes, we do have a zone available. Now, once we have identified the zone, does not mean you can blindly trade it. The reason is, yes, it might be a demand structure, it might be a supply structure, but the question always is it a qualified demand or a qualified supply where I would like to participate? And for qualification, we have a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the very first thing we'll check is that is the zone a case of level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. So how do we verify this? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify the zone we have identified. Does it coincide with any intermediate time frame zone? And the intermediate time frame, you can see we do have this drop based rally. So I'll just mark it with a different color. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is no. So it's not a coinciding level. Therefore, we have no reason to move to the lower level, right? But now I'll give you a few reasons why I moved to the lower level. The very first reason here is you can see that on the weekly time frame, we have just hit a weekly supply zone, and from the weekly supply zone, we are coming down. Now think about it as a smaller time frame being a kid and a bigger time frame being an adult. Now, when an adult is pushing something down, what is the probability a kid can hold it or maybe even push it up? That probability is very low. Now, if you think about it in terms of order flow, right? So what is happening is, if you think about how many orders will get executed in a day versus how many orders can get executed in a week, we know that this would be much larger order versus the orders which will be having on a daily time frame. So that is why when the prices are moving down, this one has lower probability to hold. So that was my very first reason. Even though we have a zone, why I would not like to use it, because this zone holding probability would be much lower compared to a zone which will be on the same time frame. So you can see the zone below is also a weekly demand zone. So in this case, if this is an adult, then this is also an adult. Now what can happen is, yes, either this can win or this can win eventually. But when we were talking about a kid, the probability was much higher that the kid will get defeated, right? But here the probability of the adult holding is still a little higher versus an adult versus an adult. So that was my first reason, that even though we had a zone above, because we are coming down from a weekly area, I preferred not to use this and move to a zone which is basically coinciding with that weekly zone to have a little extra probability stacked in my favor. So let's mark this and let's change it to demand, right? So that's the first reason. The other reason why I wanted to make that shift is because if you look into the rule book, you will see in the rule book, I have given you a rule which is page number 106, says that zones formed at breakouts are a little lesser probability, right? So what do we mean by that? So if you go back here, you can see that we have this area which has beautifully worked like an area of support and resistance in the past. You can see almost right here. In the past, it has worked like support, almost support, then worked like resistance. Here also working like resistance. And can you see that is where we had this breakout. Now, people who believe in support resistance, they will also be buying at this area only, considering it as a support level. So when everyone is buying, I also don't want to buy. I would like to be a little lower, so that when people they start exiting as their stop losses or as breakout traders, they start selling, which is where the lower zone can work like a trap, and I would be more keen on using the lower zone versus the upper zone. So that's the reason behind this rule, that when you have these zones which are almost at breakout levels, they are a little lesser probability. Plus, on top of that, I was coming down from a weekly area. That is why I wanted to have a support of weekly area and use the lower zone, not the upper zone. But that does not mean you can't use the upper one. If you are an aggressive trader, you qualify the one above, it will still get qualified for you. You can use both these zones as individual zones. But I am a little on the conservative side. I'm okay with if prices they come here and they react and I miss my trade. I'm perfectly fine with it. But I always like to be a little on the conservative side when I'm planning my trades, right? So that's a good example of a trade setup where, even though it was not a case of level on top of level, we still shifted to the lower level because of certain reasons, and I gave you logical reasons behind why I made that shift. All right, so yes, now we have moved from the upper zone to the lower zone because of some of the reasons I told you. The lower zone is not a case of level on top of level, but definitely a coinciding level. The zone is not because of a gap, therefore gap rules will not apply. Talking about pivot non-authenticity, it is a drop-based rally structure to which we always apply pivot non-authentic rules. And the rule here is that the move from the zone, if I'm just going with the aggressive rule, the move from this area should have violated an opposing zone on the intermediate time frame. And on the intermediate, you can see we had this drop based drop, and when we had this move to the upside, this drop based drop supply zone has been violated. So based on the aggressive rule, this is definitely qualified for us, so I can move ahead following the aggressive rule, and it is not unstable equilibrium. So talking about all these conditions, none of the condition disqualified the area for us. It is still a qualified area for us. And now the next step will be the booster scoring. So let's start applying the boosters and see how this one fares out when it comes to the quality and the probability factor. So talking about freshness, the zone is fresh, gets a score of 3. Strength, we have an explosive move, gets a score of 2. Time at the zone, we only have 2 candles, again a score of 2. Reward to risk ratio, we are definitely taking as an assumption. Talking about location, you will see that we are also located at the best location. We have a demand zone on this time frame, which is this drop based rally. We are planning inside of it, though we don't have any supply, but we have taken these cases a number of times in the past. If you don't have a zone, you can use the most recent pivot high as your reference point and draw it based on that. And based on that, you are still very low on the curve, which is the best location to plan a long trade. So best location gets a score of 2. Now, when you're planning your trade very low of the curve, irrespective whether you are in an uptrend, downtrend, or sideways, trend becomes irrelevant. It gets a score of 1. Move from the zone, we need minimum 4:1. You can see we already have a move which is 4:1, gets a score of 2. It was not a case of level on top of level, but definitely a trap and a coinciding level. We have already talked about it, which was another reason why I shifted below, because this will have a high probability of working like a trap. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, making it as a high quality zone with the assumption of reward to risk ratio, and 7 out of 8 for probability, making it as a high probability setup as well. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this can be done as a type 1 trade. But like I always say, no matter how high the quality or the probability, any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, so that in case the trade does not go in our favor, I'm only losing what my risk management rule allows me to lose. And that is where your position size comes into play. Whenever the prices are back, we'll have to requalify, because the markets are not static. Markets are dynamic. Conditions are changing almost every other second. And once we requalify, if it is qualified for us, we place our order based on the entry type. In this case, it's a type 1 trade. And the last step is your trade management, which we also saw in the most recent example, for which we closed the trade today after it gave us our target, which was approximately 2.7. And that is how we plan trades, very mechanically, very rule based. And now let's see what we have in the chat box. I'll answer your questions, queries, but before we get into it, I would like to add, if you're liking these sessions, do hit the thumbs up button, like the video. If you are not subscribed to my channel, do subscribe to it so that you get notified whenever I'm taking these sessions. And if you have any friends, family members who are into trading or interested in learning trading, you can definitely share the link to my channel. You can share the link to my course content, to these sessions. It might be helpful to them. So let's see what we have in the chat box for today. So yes, in the starting we have a lot of good evenings. So good evenings to every one of you. Thank you for these sessions. Could you please mention the logic behind the explosive candle indicator? See, again, if you talk about the explosive candle indicator, we'll not go into the calculation part of it, but if you just try to understand what the explosive move basically implies is that any candle which is much bigger than the average candle size, that is what we are looking at, and that is what we call as an explosive move. Now, why do we look at these explosive move? That has been covered in the booster lesson, right? So if you go to the lessons, which is the boosters, where we talk about the second booster, which is strength, right? That is where I've explained why do we want to see these strong moves, because they tell us which is the area where probably we had that imbalance and why that imbalance was there. So you can go through that video. That is going to help you with understanding. But yes, the logic here is anything which is much bigger than the average candle size, that is what we refer as the explosive candle. But we also have to ensure that the majority of that candle is also the body, right? If the majority of the candle is not the body, then again we are not taking it as an explosive candle. For the opposing zone, do I need to consider it fresh for my target or tested zone? See, again, if you talk about the targets, we are always looking at the fresh area, and the reason for that is because if you already have a tested zone and everything is in sync with your trade plan, we know that the move can be a bigger move and the tested zone can easily get violated, right? But if it is a fresh zone, it can still hold for at least a bounce. So that is why we are always looking at fresh zones for the targets, not the tested zones. But there can be some variations to it. Example, let's say if I'm planning a very aggressive trade, right? I'm high on the curve and I'm still trying to take a long trade because I know there is still room before it reaches very high of the curve, right? That is where I won't mind even using a tested area, right? So there can be variations depending upon the overall scenario, but ideally we are always looking for a fresh area if you're planning a conservative trade. All right, perfect. So I guess that takes care of all the questions, queries we had in the chat box today. Okay, so now I can see. Okay, let me see. Sujit, I'm a bit baffled. You only pull the trigger when the prices hits the zone, right? In other words, you set the trade and then enter it when it trigger. Yes, so I'll say 100% of my trades are set and forget trade because I've already identified where my entry is. I've already identified where my stop losses and I know where my target is. So for the entry, it is always placed in advance. At times, I'm not even in front of the screen when the trade gets triggered. Once I go back to the screen, I get to know, okay, this has been triggered. And after that, almost every other day after the markets they close, I try to see if I have the possibility of trailing onto it. I start trailing onto it. But yes, 100% of my trades are set and forget. I don't do type 2, type 3 trades. I don't wait for the prices to come into the zone and then the bullish candles, bearish candles. And the reason behind this is I've already answered that I am a very conservative trader. I plan very conservative trades. So that is the reason I'm not much bothered about type 2, type 3 entries. 100% of my trades are type 1 entries. You always provide clear explanation. I appreciate the live sessions. All right, perfect. So happy to know that this is helping you. And yes, that is basically the idea behind these sessions. So again, that brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye bye.